I have been watching the news, something about mortgage and Trump, and I don't know what's happening.
That's something that I think will be very beneficial, not just to you, as a young investor. Traditionally, the US, a 30-year mortgage as our standard. When you go and buy, for example, a house, balance is being then amortized over a period of 30 years. If people are being given the choice to either go for the 30-year mortgage or the 50-year,
get ready for the next iteration of you on your path to becoming wealthy. On this show, you'll get the insider's view on wealth creation, the class none of us got taught in school, with my co-host, daughter, and beginning investor, Sophia Bosch. And now, let's get started.
Welcome to the Becoming Wealthy podcast. I'm your host, Sophia Bosch, and I'm here with my co-host,
Michelle Bosch. How are you, Sophia?
I'm doing well. Okay, so I have been watching the news, seeing all the news pop up on my phone, and I've seen something on the Trump 50-year mortgage, something about mortgage and Trump, and I don't know what's happening. I don't know what the sources are, like they're telling me. Let's discuss it a little bit.
Okay, wonderful. I'd be happy to. Actually, that's something that I think will be very beneficial, not just to you, as a young investor, but also to pretty much everyone out there that is either going to be a first-time home buyer or just a home buyer in general. Even investors, agents, like everyone can benefit, I think, from just understanding what this means. So traditionally, Sophia, the U.S. Has and in the housing industry, in the real estate industry, we've had what we called a 30-year mortgage as our standard that was actually started back by, I think, President Roosevelt. And what that means is that when you go and buy, for example, a house, and you buy a house, say for, as an example, $100,000, you put 5% down, the remaining balance is being then amortized over a period of 30 years so that you can then come up with monthly payments, that you make to a bank over the next 30 years. And of course, that bank is charging interest because now that you understand the time value of money, they're taking a risk in giving you a loan for 30 years.
The amortization typically more interest than the actual payment because
At the beginning,
and then it slowly flips as you continue
paying.
because they have to, because if you don't pay, essentially it's mostly interest at first because they're
trying to basically mitigate their risk.
Yeah.
Absolutely. And as it continues on, basically what we typically say in the industry is that you have more skin in the game, more money in that transaction or in that.
So therefore you will keep
paying. Exactly. And so the risk for the bank becomes lower and they charge you less interest, or your interest portion of that payment is less as that time stretches out. Yeah. But at the beginning, it's traditionally.
Plus it's also less that the bank now has to cover.
Exactly. So what Trump is proposing, so right now what we're having in the US is we're having a situation where real estate prices have gone up. In some markets they have stagnated and may even gone lower a little bit, but for the most part in the country, we're having a situation where asset prices, at least from the housing perspective, have been continuing to go up, and people think that they're going to continue to go up. And so with that, I think assumption of that prices are going to continue to go up, we are being introduced basically by the Trump administration, a solution to prices continuing to go up, and the problem being people not being able to afford it. First-time buyers not being able to afford these houses.
Mm-hmm.
Actually, I looked up before we started this episode. The median price for houses nationwide, I think, is about $470,000, or $435,000. I think that was for a different state. The 471.
Yeah.
And
Yahoo Finance.
yes, and for the state of Arizona, actually, the median price is about $422,000, but let's say 420,000 just for purposes of this episode, because I actually prepared an example so that we could really see what it means to now stretch basically a mortgage on a house that you go out there as a first-time buyer, you're 18 years old. Say in 4 or 5 years from now, you go and buy your first home. Actually, probably the median house price is going to be higher than 422 by then. But let's assume it stays at, let's say, 420,000. I wanted to show you the difference and how much you were going to have to come up on a monthly basis, to make that mortgage payment, and what the difference would be between the 30-year and the 50-year, but also how much interest expense you would have basically, or cost to your loan over the two mortgages in a period of about 7 years. Why 7 years? Because for the most part, Americans buy a home and they stay in that home for anywhere between 7 to 9 years. But the majority of the people, it's about 7 years. And the reasons for that is, people, why are you moving? If you get accepted to the, in the Midwest or Boston, why are you moving?
For college.
For college, for a better opportunity, for new adventures, new things that you're going to be doing. People sometimes move because, for the most part, because they get a new job, and now they're moving across country. And so for the most part, the typical American family after 7 years moves to a different home. And even if they don't move geographically, a 7-year period is a big enough period where if you're 18 right now, in 7 years, you'll be 25. What if, I don't know, you get married and you want to, start a family, or you just want to buy your own home, with your future husband. So that 7-year period is key, kind of like in big life transitions for people. Yeah. And I think that's why those 7 years translate to that time period. And 7 years from that moment on, maybe now you don't have one kid, but you have 2 kids or maybe 3 kids, and people need a bigger home and so on. And so they move even within the same city. And so I went ahead, and in the past I would have pulled out my financial calculator, or open a software that we use actually for land, or the clerk sheet that we use for the land, and come up with, okay, what is the monthly payment, what is the interest cost, and what's the equity that is being built up. In this case, I actually went to ChatGPT, and I gave some parameters to ChatGPT. I gave it the 30-year loan. I know that right now interest rates are at about 6.3%. So I gave it, tell me, if I was to have a medium household price of $420,000, if I was to put 5% down, as a down payment, and I had a loan of about $399,000, can you please tell me, for a 30-year loan at 6.3% and for a 50-year loan at 6.8%, what would be my monthly payment? And ChatGPT gave those to me. And so this is something that you could have done actually, relatively. Why do you think I put in 6.8 for the 50-year versus 6.3 for the 30-year?
Because rate is interest.
Interest, right? Yeah.
For the 50-year loan, the bank has to, because it's a longer period of time, they have to basically be able to, if you default, like, pay that.
Mitigate their risk.
The risk, so the interest has to be a little higher.
They need to be compensated, exactly. So that's why I went ahead. So once I plugged that in, I noticed that, on a 30-year loan, the monthly payment was going to be like $2,500.
Yeah.
On the 50-year loan, it was going to be like $2,300. So the difference was about $130 per month.
Okay.
That I would be paying less if I took a 50-year mortgage. But what that means over a period of 7 years is that what you're actually doing is you're having to pay on that 50-year loan an additional $20,000, Sophia, in interest expense. Because remember, at the beginning of that amortization schedule,
Yeah, because
the interest is higher on that monthly payment than the principal that you're paying down.
yeah, the longer it is, the more interest you actually have to pay.
Exactly. And so that means that over that 7-year period, you will be building
Does
30.
it take into account like inflation?
No, this is not even taking into account inflation. This is just like I'm keeping the math just really simple.
Okay.
Yeah. So what that means is that over that 70-year period, if you went with the 50-year loan, you would build $31,000 less in equity over 7 years. Yeah. And so why does that really matter? And I think that's where people are kind of like, that's why there's like a lot of, I think, conversation online on if this is a real solution or if this is just a band-aid to basically fix affordability right now short term. And so I see the pros of this. And the pros of this, basically this idea or this proposal of basically having 50-year mortgages is, number one, you have a lower payment, $130 less, over the course of the year. That's like $1,500 less that you have to, come up with. Which means that it's also easier to qualify, for a loan if you have a 50-year mortgage. If it's easier to qualify, what that will mean is that there's going to be more buyers in the market buying homes and therefore continuing to push prices up. Yeah. And that's basically the pros of this whole project. Some people are calling it even like game changing. However,
Well,
I
I
have
want the prices to go up.
yes, you do want the prices to go up. And if prices continue to go up, if there's no some other crazy like black swan event, that happens, or something else in the economy that is, out of whack, that would cause the market to come down. I mean, if nothing like that happens and prices continue to go up, then this is, I think, not a bad deal entirely. Because then even though you are having less equity, you would be basically the asset would be
still have-
appreciating.
And you have the ability.
Yeah, the asset would be appreciating, and then you're like, oh, okay, then my timeline is okay during that 7-year period, because even though, yes, I'm having less equity, but the appreciation of the house is kind of compensating for that less equity that I'm building,
Yeah.
over the 7 years.
Let me just get this right. So if prices keep going up with this 50-year plan, assuming that your wage or like your income,
Salary.
your salary stays the same,
Mhm.
it would allow you to actually afford and keep up with the rising prices. Is that right?
Well, once you're in the house, you're basically locked in at that rate. And yes, and you would be, if in 7 years, say you get a new job for more money and you need to, or you're having the situation where you now are in a starter home and now you have 3 kids and you need more space, an extra bedroom, you could move up basically to the next house. Because if prices continue going up, that kind of loss in equity is basically offset by the appreciation of the asset. Yeah.
Right.
And you're like, okay, I'm kind of like in the same situation as if I would have had a 30-year mortgage. However, we cannot predict the future. None of us has a crystal ball as to what's going to happen to to prices of homes. And so what I think is a much more fiscally conservative approach is to think also about the cons. And what I think about the cons, or the things that are against this proposal, in my, from my perspective, is that you now have, over the life of the loan, which is now 50 years, or even over the life of 7 years, you have a higher interest expense. You're having to basically come up with more interest to pay for the bank. And if you're the bank, like we are in the land business when we offer seller financing, Well, that's great.
Yeah.
We
He's
get
like
more interest income.
receiving it, but
We're
not
more interest income, but for the
paying.
person paying, it's a bigger interest expense. Exactly. And so that means that my equity growth is much slower over 7 years, or over the 50 years as well.
Mhm.
And what if prices plateau, or prices, go down? I'm now stuck. I'm stuck, and I'm not building equity. And I think one of the beauties, I think, of this country, or one of the reasons why, for example, Papa and I immigrated into this country, is that we knew that we could work hard, buy a home, and build equity with that home. And in 7 years' time, we could pull that equity out and use that equity to do what we play when we play cash flow for kids,
Mm.
which was pull that equity out, buy a second home, with the equity from that first home, and now have that as a rental, and have it pay itself off over the next 30 years. And in 7 years' time, equity building from this second home being pulled out to buy a third home.
Yeah.
And the game,
Yeah.
right? Cash flow for kids. And so now, when you are building in that 7 year time period, $30,000 in less equity, that means you cannot pull that in a line of credit to do what I just explained to you right now, or to put it into crypto, or to send your kid to college. Right now we have to pay for tuition, or perhaps having a home improvement project and add a second or third bedroom to the house, or remodel the kitchen, or say somebody in the family gets sick.
So
And
why can't you do that?
because now you don't have that money. Like, in 7 years time frame, if I would have paid down my loan, right, and I would have built those $31,000 in equity, I could have then gone to the bank and say, can I refinance, or can I get a home home equity line of credit, for those $30,000, and
Yeah.
pull that money out, basically. Yeah. But I'm foregoing that with the 50-year mortgage.
You
I'm
don't
I'm
have
I'm,
that?
I'm You're not building that wealth. So your own home, for most American families, Sophia, is the single most important source of wealth building for the American family. And now all of a sudden that is being eroded with a 50-year mortgage. So that's my opinion. However, I also see that we're in an extraordinary situation, and sometimes extraordinary situations require extraordinary measures. And so I can understand why the Trump administration is coming up with this as a possible solution. However, I think about it again, not as just a solution in paper, but as a solution as, how does it affect you? You buy a home right now in your 20s, and in your
Paying it
50s,
off,
you would have paid it off
but now I have to wait until
until
my
you're 70.
70.
So until you have grandkids.
That's I'm not okay with.
So basically we're going from,
So it might be good short term, however, long term it's not
it
ideal.
comes at a great cost. I think it comes at a great cost, absolutely. And that's basically the whole argument, I think, from my perspective. In that, also, if you have a 50-year mortgage, a lot of people, Sophia, what they do is, because they can now afford $130 more in monthly payment, let's say, they would go for a bigger home. Which, what does that do? A bigger home is sometimes a home that stretches them financially, and that does not allow them to save. That basically, it would continue, I think, perpetuating not really good fiscal discipline habits of living within your means. On the contrary, it would trigger people to basically perhaps look for a higher price property, a little bit, higher price than
Because
they
they
would,
can now.
because they can now afford 130 to pay $130 more, you know. So I don't know. So that's the whole thing. That's what do you think?
Um. Yeah, I don't want to be paying off my house
Until you're 70?
until I'm 70. And think about it. If you end up if I don't end up buying a house in my 20s and in my 30s, then it would be 80. Like, no.
And most people, don't stay in that same home.
Yeah, true. But still, then I think about, this is a very simple example,
Mm-hmm.
but how about when prices continue to increase, then somehow you have to pay for the higher price and then be paying more interest if you wait long, like the time value of money. Like, it's a whole
Yeah, yeah. So it's at
mess.
the end of the day, I think that if people are being given the choice to either go for the 30-year mortgage or the 50-year, and they're educated, or somebody sits with them before they sign off.
Typically, no.
Well, but if they were to be educated and say, okay, this is how the financial picture looks for you,
Yeah.
if you went with the 30-year versus the 50-year, and this is how much, not just the perspective of how much less the monthly payment is going to be, because that's what most, I think, people will be presented. They'll just be presented with the fact you have a lower monthly payment, but they're not going to bring in the point of, like, but look at your interest expense over the next 7 years.
Like, this is at Wharton.
Yeah.
We, in a big lecture hall,
Mhm.
one of the main professors,
Mhm.
finance professors at Wharton, explained this to us. He did this ChatGPT simulator. He showed us like a
Mhm.
10-year versus 5-year on a
Mhm.
car.
Mhm.
And he's like, look at your payment. It's so much less. And there he asked it, which one would you go for? And most people picked the 10-year because the payment is less. But then if you look at the interest in reality,
Mhm.
it doesn't, it's a different story.
It's a different story. Yeah, it basically gives affordability short term, but long term is not necessarily the better deal, because you're having
Yeah.
basically the higher interest expense, and in a car that's like terrible, because
The car
value of the
value.
exactly
Period.
exactly, the value of the car goes down versus hopefully the value of an asset, like real
Maintains
estate,
itself or
maintains or goes up. Yeah, but we've had situations where they go down. 2008, that's exactly what we saw. And some people, even, that have purchased land from
Yeah.
us on monthly payments, started missing their payments. And what I had to do proactively is basically reach out to them and say, do you want me to tag these payments, that you're behind at the end of the loan? Or do you want me to stretch the loan, from 3 years to 5 years, to bring monthly payments down, to make it more affordable for them? And that was kind of like a band-aid for like an extraordinary
Yeah.
situation in a really downtown market cycle that we were in. But I generally speaking,
In a
from
good
yeah,
time, or
yeah,
like in a
yeah, but for me it made sense also as the bank, because if I was to take that property back, because they would
you could just go.
default, I would not be able to sell it for the same price that I had sold it to them, because now
Yeah.
prices of the real estate was lower, so I would
It was
so
in
it was
your best interest.
to extend the loan for them, number one, or sometimes even say, hey, if you can pay off the loan in full, I'm willing to give you a 10 or 15% discount, you know, on the principal owed, on the balance owed, because I knew that even with that discount, I was still coming
You're
ahead
losing.
compared to the prices currently for that exact same piece of land.
Yeah.
Yeah. So yeah, so I can understand a short-term band-aid fix, but long-term, I think it really is reshaping how wealth is being built in America. And yeah, and if people are not educated, if people don't understand really that it's
Yeah.
not just the affordability of the monthly payment, but there's these other issues as well.
Because typically they just show you, oh, this is the 30 and 50. Which one would you like to do? But they don't fully break it down.
Yeah, exactly. Well, and so was that clear as mud, or
Yeah.
clear?
It took me a second, but I think it's clear now.
You understand it. Yeah. Okay. Well, thank you very much for joining us in another episode of the Becoming Wealthy podcast. I sure hope this was helpful for you in understanding what's going on right now, in the real estate industry, and with the Trump administration, with the whole 5-year mortgage proposal. Like I said, it's an outside the box idea. I understand where they're coming from.
Yeah.
There's some pros and cons to look at. But in general, I hope this was helpful. Share with another, important woman in your life, and definitely give us a 5-star review. And we will see you on another episode of Becoming Wealthy.